Reading Cram, Buy versus Sell 5, Supply and Demand. To order this complete Cram session, inbox me at memedicine@gmail.com. Buy versus Sell, Supply and Demand in Forex. We're now going to analyze how and why exchange rate between currency pairs fluctuate using the concepts of supply and demand. Let's analyze how and why exchange rates between currency pairs fluctuate using the concepts of supply and demand. We're going to use the comic book analogy to understand what supply and demand looks like on an exchange rate chart. Imagine you're trying to sell comic books to people who like to buy them. When do you think these collectors would prefer to purchase them? Of course, when they're being offered at a cheaper price. Let's say a collector purchases your comic book for 25 cents. Over time, as other collectors begin to notice that your comic books are being sold out at relatively cheaper rates, more collectors buy your comic books. Now, your comic books are in really high demand, and you tweak the prices a bit since your newfound customers have built up such a strong mental and emotional desire for your comic books that they're willing to pay for them. Your comic books are being purchased so much that this market activity hits a region called overbought, meaning no one else is mentally or emotionally driven enough to purchase your comic books because they have gradually become too expensive. In fact, this would be a really good time for collectors to sell the comic books they purchased from you for a profit. So all your previous customers begin selling off their comic books. As these sellers sell, they flood the comic book market again with an overwhelming supply of comic books, and the value goes down. Now, we're going to neatly exit this imagined comic book scenario and re-enter the world of Forex. Interpret this chart from the perspective of a currency exchange rate market. It is important to know what is actually happening when you place an order in the Forex market and how this affects the supply and demand of your respective base currency. When a market participant places a buy order, that is purchasing a base currency in exchange for the respective quote currency that you have, what's happening is they are causing the exchange rate's value to rise. Why? Because the market participant wants to purchase their respective base currency. When you have a buyer that is actively seeking to acquire your asset, that is your respective in-demand currency that's of value, you can automatically begin to demand more value because they are willing to pay for it. So as the demand increases for the base currency, the exchange rate rises. This rise is recorded in market databases, and hence you see this rise reflected in the live exchange rate charts. On the flip side, you have sellers. Sellers cause the exchange rates between a currency pair to fall. How? As major market participants, this includes corporations, banks, hedgers, speculators, you name it. As these major market participants purchase the base currency of their respective currency pair, the value raises until it hits the overbought region, upon which they begin a massive sell-off of their base currency, and the value decreases because there is no longer a high demand for it. Because, as I previously indicated, they're flooding the market with a supply of currency to be specific, thus lowering the demand for that currency. As the demand for this respective base currency continues to fall, so does the value of this currency. Again, as traders place plenty of sell orders, they're actually causing the value of that currency to go down. The market records this information and presents it as the live exchange rate charts you see in the technical analysis windows of your trading application.
Give me pound, give me pound, give me euro, give me give me pound, give me pound, give me euro, give me. I'm international, baby, I'm international, pay me.
Do you take check?